Should I put some money in Marcellus? It's a question that has popped up in my comment section a dozen times, maybe more. And every time my first thought is, कितना पैसा है यार इसके पास? So many of us have heard of Marcellus Investment Managers. It's a boutique asset management firm that was founded in 2018 by Saurabh Mukherjea and operates a number of funds and portfolios that are focused on creating long-term wealth for their clients. You can read a lot more about Marcellus, their fund management team, their funds, etc. on the company website and marketing materials. But in this video, I will be focusing on a few key areas that aren't that easy to discover and will probably give you a better idea of how Marcellus thinks and works. If you like this video, then do give it a nice big thumbs up. And if you're a Marcellus client, then do share your experience in the comments box below. Let's begin. My first point of inquiry was to understand the company's thought process, their guiding principles. And for this, I went through a dozen videos on YouTube and I've also linked a few of the good ones in the video's description. Now, Mr. Mukherjea is a fantastic storyteller and there's a lot of clarity, structure, examples, confidence, and an emotional resonance in what he says. But broadly, I figured there are four main recurrent themes. The first is polarization, which is a fancy word for saying the big are becoming bigger while the small players are falling by the wayside. The team at Marcellus explains this with data where they say the Indian stock market has created $1 trillion of wealth in the last 10 years, but 80% of the $1 trillion have come from just 16 companies. In case of profits, the top 10 nifty companies account for 85% of it. More than 70% of Indian companies are delivering negative free cash flows. And it's this dichotomy which, according to Marcellus, is leading to a strong polarization in stock prices as well. Now, the question is, why is this happening? Well, according to Marcellus, it's a result of the fundamental changes that India is seeing over the past 10 to 15 years. The road networks have doubled in the last decade, mobile connectivity is up 50 times, air traffic has grown by a multiple of 4, there's UPI, there's GST, there's Jan Dhan Yojana, and all of this network effect seems to have made it a lot easier for national players to consolidate their power in just about every sector, which not only decimates the regional competition but allows these biggies to compound at 20, 25, 27% CAGR, and that's a theme that the Marcellus team recognizes and participates in. The second operating theme is to look for great businesses run by great people. Now, the people part is really important because a large number of Indian companies have questionable ethics and governance issues that the Marcellus team is very mindful of. So we're talking about creative accounting, financial irregularities, embezzlement, diversion of funds, insider trading, etc. And as per Marcellus, if 1,000 Indian companies are put inside, let's say, a governance washing machine, then maybe 20-25 odd companies would come out clean and dry. And why is it important? Because it's these 20 odd companies that have beaten the Indian stock market by 10% year on year for many years, which explains why Marcellus puts a lot of weightage on clean companies. The third theme, and something you would have heard often, is consistent compounding. So the first part is consistency, and Marcellus has said it in many forums. They prefer companies whose earnings are growing and those earnings are not volatile. Now, there are arguments against this. The first is that finding such companies is not easy, and when I was searching for companies that had grown their revenue by 10% in each of the last 10 years, I found just 4 of them for my coffee can investing video. The second argument comes more from value investors who actually prefer lumpiness in earnings as it often delivers a higher IRR as compared to a steady ship. Anyways, I think Marcellus prefers consistency because they have certain volatility targets for their portfolio, and using a linear growth chart also reduces a lot of the entry point risk. The second phrase is compounding, and while anything can be compounded, sales, profits, EBITDA, capital expenditure, etc., the team at Marcellus has a preference for using the free cash flow as that compounding factor. Now, in simple terms, free cash flow is the money that remains after everything and everyone has been paid off. To put it in a very Hindi way, it basically means galle mein kitna paisa hai. But an equally simple way of understanding this is from a return on capital and a cost of capital perspective. So companies that have a high ROC will typically generate a high free cash flow, and let's assume that's 40%. Incidentally, the very same companies are viewed as less risky by investors, giving them a lower cost of capital, which let's say comes to 10%. Okay, so simple math here, a 40% ROC minus a 10% COC will most likely give us a free cash flow compounding of around 30%, and that's what the team at Marcellus is looking for, a business that can compound its FCF at 25-30% for the next 15 to 20 years. And the fourth and final guiding principle is valuation. I think this is where there are likely to be a lot of questions and introspection. You see, Marcellus says the price earning ratio, the PE ratio, is a redundant metric, and it has said that in many forums. Their point is, if one can identify a company that is growing its earnings and free cash flow by say 25% year on year, then it shouldn't matter even if that stock is purchased at a high PE. If I put it in numbers, and I'm being a little repetitive here, then what Marcellus is saying is that if you find a well-run, low-competition franchise that can sustain a free cash flow compounding of 25% for the next 15 years, then it's okay to pay up to 80 times, even 100 times the earnings, and one will still make good money on that stock. Case in point are stocks like Asian Paints, which have a higher market share, and they've been consistently compounding their FCF at a CAGR of 24% for the last 25-30 years. The same goes for a stock like Titan, which has been annually compounding at 40% since the year 2000, and by the logic given by Marcellus, it is even justified a PE of 200 if you have the stomach for it. Now, convincing a PE of 200, 120, even 80 to a value investor is extremely difficult, and the argument from that side of the fence is that it is difficult, almost impossible, to predict cash flows and earnings so far in the future. I mean, take Titan as that example. So between 1990 to say 2003, so for a good 13 years, there was no real indication that Titan is going to do so well and consumerism is going to explode in India. But because that macro play happened, Titan has been able to reap the benefits of it over the next 20 years. Now, the value investor's point is, what if the opposite happens and the Indian consumer becomes a lot more minimalistic over the next 2 decades? It's a problem of projecting too far into the future, which obviously the Marcellus team counters by focusing on established companies with a big brand and a big market share, by opting for businesses that are physical rather than digital, therefore disruption is not that visible. The team looks at what's happening at the external environment, and it's not that they ignore valuations, maybe they just give it a little lesser weightage relative to what you or I might give. And as it stands, the CCP portfolio of Marcellus is at a PE of 58, which is high given the fact that they've had a troublesome 12 to 18 month period. So between valuations, polarization, people, and consistent compounding, I think I have addressed the major themes that Saurabh Mukherjea and his team takes into account when structuring their portfolios at Marcellus. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips, and stories that I continually post in the community section. Marcellus Investment Managers offer a range of portfolios to their clients. There's the flagship Consistent Compounders Portfolio, or CCP as it's popularly called. Then there's Rising Giants, which focuses on small and mid-cap companies. There's Little Champs, which is a portfolio of sub 5,000 crore market cap companies. And Marcellus also has something around global companies, financial stocks, and also a quant-based fund. I'll be focusing on the first 3 in this video, and there's a lot of commonality in how these 3 portfolios are constructed. So the first layer is forensic accounting, and Marcellus takes the entire universe of eligible companies and puts them through a dozen accounting ratios that helps identify companies that have clean accounting practices. They look at metrics like the operating cash flow to operating profits, contingent liabilities as a percentage of net worth, which I explained with an example in a previous video, the capital work in progress to gross block ratio, etc. Other than metrics, the team also looks at qualitative factors like the composition of the board of directors, related party transactions, etc., which helps them build an understanding of the company's moral fiber. If you want to know more about forensic accounting, then do read this book, Financial Shenanigans, and a lot of what Marcellus does actually comes from this very book. Now, the research done by Marcellus shows that clean companies, companies that follow accurate accounting practices, do a lot better in terms of wealth creation for their shareholders, and the team reckons about 40% of the original set of companies drop off at this forensic accounting stage. The second layer in the construction of a Marcellus portfolio is capital allocation. It's something the team seems to have borrowed from Robert Kirby's original coffee can investing principles, which calls for the identification of companies which have given double-digit revenue growth every year for 10 years in a row. And secondly, the return on capital employed has been in excess to the cost of capital in each of those 10 years. So the data with Marcellus shows that a portfolio based on these two filters would have delivered a CAGR in excess of 20% on most occasions, and at a low volatility that's similar to a Government of India bond. The third layer in the portfolio construct is to identify companies with high levels of competitive advantage. Now, Marcellus looks at competitive advantages from two perspectives. The first comes in the form of high barriers to entry, that is, how deep is the competitive moat of the business, whether the company has been incrementally deepening it, how strong is their pricing power, and of course, an assessment of the kinds of investment the company has been making to build new drivers of revenue growth. The second part to competitive advantage relates to the company's management. This includes questions around their focus on the core franchise, that's the main business, the quality and tenure of the management at the firm, decentralized execution, the board of directors' independence, succession planning, etc. This is also the stage where a lot of bottom-up analysis happens as the team tries to find why or why not something happens. For example, we've talked about how obsessed the Marcellus team is when it comes to free cash flow. Now, in one of their presentations, they've even explained the free cash flow growth breakup of a company like Asian Paints, which I thought was particularly interesting to understand. So Asian Paints has grown its free cash flow by 27% annually over the last 15 years, which means if the FCF was a rupee in 2006, then it has grown to 36 rupees in 2021. How did they do that? Number one is sales growth, and as we see here, the revenues have increased by 14% per annum over this 15-year period. Step two is an increase in operating margins, and over time, Asian Paints has squeezed a lot more efficiency, which enabled its profits to grow at a rate which was faster than its revenue. Step three is working capital reduction, which is also an efficiency metric, and it means the company was paid a lot quicker, it paid the suppliers a little later, and over time, the company also managed to reduce its level of inventory. Number four is the reduction in taxes, which has nothing to do with Asian Paints, and it's the Government of India's kindness to them. And finally, there are asset turns, that is, how hard is Asian Paints sweating its factories using automation, process improvements, etc. And 4% is a big number. My point is, an understanding of these waterfalls in addition to management meets and conducting third-party checks gives the analyst a very rounded picture of where the company stands, the growth drivers, where are they going wrong, and most importantly, does this company fall within that framework, that box that Marcellus has defined for itself. So net, this portfolio construct, which started with 1,000+ companies through a combination of hard metrics and softer qualitative aspects, is brought down to just 20 to 30 stocks, which comprises the different portfolios that Marcellus offers. It's been just 4.5 years since Marcellus opened shop, so from that context, it's done extremely well to garner over 10,000 crores in AUM with more than 8,000 clients. Now, for all this interest, this popularity, the performance of the consistent compounders portfolio has been just par for the course. In fact, on a year-on-year basis, barring the initial years of 2018 and 19, the CCP certainly comes up short when compared to the Nifty 50 TRI. A similar pattern shows up when I look at the Rising Giants and the Little Champs portfolios, which accentuates the fact that, like any active portfolio, even these three portfolios of Marcellus will have a cyclical existence, a bit like the periodic ups and downs we've been seeing with AMCs like Axis, HDFC and Kotak. So essentially, and that's what the folks at Marcellus have been telling their clients, that these portfolios are strictly for long-term investors who believe in the story, the hypothesis and the methodology that the Marcellus team has put forth. On a side note, I should also mention that there are some lessons in marketing here, with Marcellus employing an aggressive communication strategy using newsletters, webinars, interviews on YouTube, appearance on business news channels, etc., which has all helped in communicating their strategies better and increasing their assets under management. Now, personally, I haven't made up my mind on whether I want to be a Marcellus client or not, because firstly, मेरे पास 50 लाख तो है नहीं, and secondly, the researcher in me continues to have some lingering questions around free cash flows and valuations, which I hope I can have a sit down with the Marcellus team and clarify. But as a concept, as a criteria set, I think there are some things we can certainly pick from here and adapt it to our own investing strategy like we have done with other videos on my channel. Things like a focus on companies that are growing their revenue and gaining market share, businesses that are generating free cash flow and allocating capital efficiently, those that conduct their business in a clean, ethical way, and we have some metrics to help us out with, companies with a quality management team, companies with competitive advantages, where the return on capital is a lot higher than the cost of capital, etc. So there's a nice big list for us to work on, and I also like the fact that a lot of what Marcellus does is formalized, which removes any kind of biases or emotional decision making, and it's something I'll want to do more often. So this was my assessment of Marcellus, and yes, while there are a few question marks, a few counters, a few arguments that I've raised, I sincerely hope this presentation gives you a clearer picture of the way this asset management firm thinks, manages and operates. Once again, thank you for your time. Do like this video, share this video with your friends, and I'll see you 3 days from now. Until then.